All right. Good evening, everyone. Tonight we just have our grant winners with us, but we are going to share this with everybody else. Thank you so much for being here. And we have a great speaker with a lot for us to learn this evening, Deb Purvin. And Deb, we're a little more casual on these, so we let you introduce yourself.
That's perfect because I have a couple of slides to do that. But Donna Lisa, you're going to manage the people coming in as well,
Yes,
right?
and me. Yeah,
Okay, and
Yeah.
Tracy. Okay, fantastic. And
Tracy, do you know this person?
no.
then the other request I have is if anyone has comments or thoughts or questions, please, raise your hand, do a shout out, put it in chat, and then Donna, Lisa, and Tracy can hopefully just interrupt me. Please interrupt me. I get going and I don't look at anything but what I am prepared on the screen. And so, but I'm really used to people just yelling at me or or going, wait, you've lost me, because I am going to run through quite a bit of information this evening. So please feel free. Congratulations, number one, for being our grant winners. And two, please feel free to interrupt at any time that what I'm saying doesn't make sense to you or doesn't resonate, because that's the only way you're going to learn. You're not going to, we all think, oh, I'll go back and look at the video or I'll go back and do this, but just interrupt me, because if you're not getting what I'm saying, you're not alone. And I'm not being clear. So I'm going to share my screen and we will get started. Let's see, she says calmly. I do this every day, several times a day, but I still have to work through it one at a time. How come I can't remove this view thing out of the way? Okay, so I am going to talk today about simplifying your financials. And I'm going to talk really about two of your most common financial statements that y'all work on, the income statement and the balance sheet. And so this, I hope you recognize, is Indiana Jones, and he's being chased by this gigantic boulder. And I use this slide because this is how I felt when I ran my companies. I always felt like there was this big boulder coming at me and I wasn't sure what was behind me, and I was running like a devil, but I knew what was in front of me was just as bad. So I want you to understand that this is pretty much how I felt during my entrepreneurial years. So if you feel this way, you have good company. If you're more organized than me, you're way ahead of the game. So I skied on the US ski team as a kid, and then I went to Dartmouth and Harvard. So I had really great pedigrees when I entered the banking world and went into construction lending, and I worked for a real estate developer. I left the bank and I went to work for a real estate developer, and he developed big single family tracts. So he built 100 single family homes, but he was a great builder, but had never been a developer. So the deal was I would help him get a loan. I would help him get it permitted, because those were my degrees, and that was what my degrees were in. And that he would partner with me, or I would get to have ownership in the retail corner. So I built the retail shopping centers, mostly neighborhoods, like this one, with a grocery store and a CVS, and your usual neighborhood shopping centers. And all of that sounds really wonderful until late 1980s. That's how old I am. All the banks went under. And when all the banks went under, and the savings and loans and the people who were financing real estate, they called your loan. They didn't go, gee, we're sorry. We know you're making payments, but we're not solvent. So that's okay. No, they said, we're not solvent. So we're going to call your loan. And there was no place to go because everyone in Texas, every bank in Texas went under. And so you couldn't go to the next bank and refinance. So you were just like, well, what do I do now? And all of my loans, I had 8 properties and about $65 million that I owed. And they're all calling the loans. And I'm like, this is not good. Now, I wasn't alone. Every single real estate developer in town in the state had the same problem. And so what happened was the government brought in, or other banks from out of state came in and they bought up portfolios, they bought up banks, and everything got aggregated into other banks. And I was very fortunate that all of my properties ended up in the same bank and they were cash flowing. So the bank said, hey, no problem here. You just go ahead and cash flow, but we'd really like you to sell. We don't want to be holding any real estate. We're not really long-term real estate lenders. We're short-term lenders. You've built it. We've got it up and running. Now go sell it or refinance it long-term. And so that's what I did. I sold everything. Now, it took 3 years. It was horrible. We were in courts. And so when I finally sold everything, I was like, that was the worst 36 months of my life. But I actually ended up with some money. And so my husband and I and our 2 children got on our sailboat and we spent 5 years sailing through Central and South America. And it took about 5 years to get over it. Here we are in off of Guanaja, which is in Honduras. So I told the guy that was running the bank, if I ever want to borrow money again, don't let me do it. And he said, look, you are the only developer in our portfolio that paid us off. If you ever want to borrow money, let me know. And I was like, no more. I'm not doing it. And then we were out sailing and I got a call from one of my friends who said, there's this resort for sale and it's got a ski area and it's got a golf course and it's got 2,000 permitted units, which in Vermont were very unusual. You really should think about buying it. So I called my friendly banker and I said, remember you said you would lend me some money? And he said, yeah, what do you want? And I said, well, what's your limit? And he said, well, I can lend you up to $100 million. And I said, that would be good. So I borrowed $100 million from my banker friend and we bought the resort. And we redeveloped the golf course, my husband and I, and we did have some investors. We redeveloped the golf course and we redeveloped the ski area. And the second year that we had the ski area, I built this base lodge. The second year we had the ski area, I was standing on the very top of the mountain there that you can't really see. And it is Christmas week. It's the day after Christmas, which is when everybody's there. It's our biggest revenue week. And it is pouring rain. It is just pouring rain. And I was like, okay, this was not in the plan. And I'm thinking the sky is crying. I'm crying. My mountain's crying because I spent $2 million making snow and it is running in rivers down the mountain. And I'm thinking, what have I done? I have 150 employees. How am I going to make payroll? And all of our guests at the resort, they all are from Connecticut and New York and New Jersey, and they've all driven up here from their home, and they're all getting in the cars and driving home because who wants to be at a ski resort when it's raining? And so that was not a good year. That was not a good year at all. I lost a lot of money, and it took quite a long time to recover. But when I was standing on the top of this mountain, I had this brilliant idea that I wasn't alone. I was in a beautiful valley of beautiful old farmhouses and converted bed and breakfasts. And we had a big lake with water activities, and we had so much there to offer. I thought, wow, I'm not the only one. There's a ton of other business owners here whose whose bed and breakfasts are empty, whose diners are empty, whose fancy dinner plate restaurants are empty. So I got everybody together. I said, what we need to do is what the big resorts do. And the big resorts sell you Christmas packages and weekend packages. And so when you're there, you've already paid for it. So regardless of what the weather is, you're going to enjoy the amenities that are there. And so I taught 42 people into it. I'm going, we're going to have a cooperative and we're going to have price points and we're going to have to decide what those are and how we do our raffles. And I'm going through all these things that I'm thinking of. And I had 40 some odd people sign up and say, I want to be part of this cooperative because I will, if I survive the year. And I was like, perfect. And then every one of them came in my office over the next week and said, I have no idea what you were talking about, price points and all of this. And I was like, great. Now I have this big resort I have to manage, and I have to manage 42 other business owners' businesses and teach them how to run the business. And that was like, what a great idea, Deb. You've just created more work for yourself. But what it was, and you never know what an opportunity looks like. What it was the basis of my business owner's MBA. And so those 40 people, we got together every week and I said, okay, this is long before the internet. I said, just write on a just write on a note card any questions you have that come up in running your business. And every week I'll give you a little worksheet and we'll work through all these questions that you have and help you learn to run your business. And so over the next 6 years or 6 or 7 years, every single one of those 42 business owners, including me, sold their business for more than $1 million net. So I had a system that had taught these business owners how to run a successful business. And so I'm very proud of that. And that's what I've been doing for the last 30 years is exactly that. When I sold the business, I went back to work in banks. I took a couple of years off and then I went back into banking and ran some banks. And now I retired from my bank. This is my new boat. I live on this during the summers. It's in the Chesapeake. And I teach Goldman Sachs and I teach my Bamba classes. So that's a little bit about me. So I got here the hard way. I learned every single lesson the hard way. And so how I think about business is in 4 different pillars. Okay. And I think you'll see some of these, or you have already seen some of these in the program that you're in. So the first 3 pillars over here, can you see my pointer or am I just pointing all by myself?
We see it.
Okay, good. So positioning is who are your clients? Who's the market? How are you positioned in the market? What are the pricing? What's your services or your products? And what's your competitive advantage? Processes, these are all your internal operations, including marketing and sales. Those are internal, obviously trying to get clients and prospects in, and then your operations, delivering the product or service, and administrative. So those are your processes, and then people are obviously the folks that you hire to deliver those products and services. That is what most businesses and business schools teach you. What we do a little differently at Bamba is we add your financials to it because every single one of these decisions has a financial impact. And the financial impact helps you make good decisions. So I have people calling me all the time. Can I afford to hire this person? I'm like, I don't know. Let's look at your numbers. Is this a profitable contract? I don't know. Let's look at your numbers. How come I'm not making any money? Well, have you raised your prices? I don't know. How do your prices compare to the marketplace? I don't know. So every decision you make has an impact on your numbers. And the reverse is true. You can look at your numbers and see if you've made good decisions. So your numbers are your scorecard. Everyone agrees on the numbers, but nobody knows what they mean. Now, this is really true because where some people will learn accounting is very different from finance. Finance is taking those accounting numbers and figuring out what they mean. So we'll come to that in a minute. There are only 3 ways to grow your business, and we're all here. We've got some grant money. We're going to put it to work. There are 3 ways to grow your business. The first way, and the most expensive, is to acquire new clients, new customers, right? You have to go out, prospect, you have to find lead generation, you have to prospect, you have to meet them, you have to prove that you have a solution to whatever the pain points are that they're suffering, and that your solution is better than the other things in the marketplace for whatever your competitive advantage is. And then you have to price the product so you make a profit, but your customers feel that's a good value. And value is important, not just at the cost, but there's a value. The value is the difference between the cost and the value that the client sees, and that's where your profit is. Okay? It's a lot harder to do that than the second way, which is to develop products and services that you can sell to your existing clients. So think about the clients that you have. What else could you sell to them that would be beneficial to you? And then the third way is obviously raising prices. Now, that's the easiest one to do in terms of the amount of time and effort, but it's the hardest one to talk my clients into doing because they're thinking, oh, my clients can't pay anymore, or that's really hard, or I'm not sure. And we're going to talk a little bit more about that. But I hope this gives you a way to think about when you're how you're going to spend your grant money, what you're doing, that it's easier to do raising prices and to sell new products than to acquire new customers. So use those as the first questions when you're looking at how am I going to grow. Now, here is my favorite chart. And this will answer some of the questions that are going through your mind with respect to growing your business. This is called a whale chart. And these blue dots are the profitability of individual clients. Now, these are taken from the New York Stock Exchange, a conglomeration of companies, and these are, each dot is a customer. Now, the pink line is the cumulative number. So if you looked at the financial statements of these 20 clients, you'd be like, wow, they're making lots of money. Isn't that wonderful? But 20% of them are underwater. They are not profitable. Okay, so when we're talking about running a business and making good business decisions, you have to understand who those not profitable clients are and become more profitable by getting rid of them or raising prices. Okay, the easiest way to grow your business. The second part over here, the other 20% are very profitable. They're way above the break-even line. And so these companies, I want you to think about, so everybody knows who their non-profitable customers are. Which ones are your profitable customers? What are you doing for those profitable customers that you could do for all of the ones right here in the middle? So the really scary thing about the profitable customers is their 80% of your profits come from those 20% clients. So when you tell me, and when clients tell me that they can't increase the profit on their 60, 55% of their clients, I know that's not true because we know they have profitable clients. So all of this is really important when we get down to looking at our income statement. Now, QuickBooks calls your income statement a profit and loss. Not a big fan of profit and loss. I think it should be called an income statement because it's bringing in revenue. It's your income. And I really don't want to see losses. So I always call it an income statement. And the income statement is put together by your accounting based on generally accepted accounting rules. So I'm sick and tired of generally accepted accounting principles. Now, some people think this is your accountant, but I think this might be the business owner because your general GAAP, generally accepted accounting principles, really doesn't help business owners understand what's going on with their number. It's to help accountants. It's to make sure that the transactions, when you book a sale, that all those, the costs of paying your clients, the costs of putting the numbers to all of the costs for running your office are properly put in your accounting system so that the accountants can look at different kinds of industries, different kinds of companies, and know exactly what's going on in your business. But it's not made for business owners to help you understand their numbers. But number one, the picture I showed you, they had 8 pages of QuickBooks line items. So the more line items, the easier it is to put those transactions into the right line item. But it's really hard to aggregate and look what's going on with my business when you've got 6 pages of line items. So what we do in the finance world, is we interpret the results that you get from your accounting systems. What your accounting system tells you is historic, what's happened. And in finance, we look at it and go, okay, what do we want to have happen? What are we going to look at in the future? What are we going to project? We look at revenue trends, and then we decide, hey, what are we going to do? How are we going to make more money? How are we going to grow? And those are all under finance, not under accounting. So we're going to take your accounting, your numbers, and we're going to simplify them. We're going to turn all those numbers into, instead of 6 pages, we're going to have 12 to 15 line items. And we're going to make it simple to understand by breaking it into these 4 groups. Now, this is something that I can send you the template, but this is something that every business owner, every large business owner's CFO does. But a lot of small business owners don't know to do this, and then therefore they don't get the benefit of understanding what these numbers say. So there are really 4 items, 4 different categories that we're going to look at. And I'm not suggesting this is absolutely 100%. You are not going to change your QuickBooks accounting, but you are going to run my recommendation is that you run a spreadsheet that aggregates your numbers differently, as I'm going to discuss next, because this is going to give you the information that you need to make good decisions, and you'll see why. So the categories are, the first category is your revenue. Right now, most businesses have QuickBooks as just a revenue line item. But my recommendation is that you break that revenue into the important parts of your business. If you're a retail shop, here's retail, and here's my e-commerce. If you're a doctor's office, here's money being paid by the insurance, and here's money being paid by the patients. And you'll see the example of my golf course. So these are the drivers. These are the pieces of business that you want to watch. Which part of your business is growing, and which one is growing slower, which one's growing faster. And then we're going to look at the margins. The second part are your variable costs, your cost of goods. The variable costs are the costs, what you spend money on to produce your product or service. So if you're a consultant, you're going to have all your consultant salaries up here. If you're making a widget, you're going to have your materials and your laborers, and maybe selling, moving the goods to the transporting them to your customers. So these are the costs associated with making your product. And the most important part about these is when your sales go up, the cost of your variable costs will go up as well. What happens when people grow their business? A lot of business owners grow their business and they go, oh, I grew by 20%, but they are not watching how fast their expenses grow. So these variable costs are the ones that grow just as fast as your revenues, and you want to make sure that you keep that margin in place. And I have a chart that will show you how important that is. So variable costs change with the revenue. As revenue goes up, they go up. As revenue goes down, hopefully, you are reducing your costs. You may have to lay off someone. If you lose a big contract, you're going to have to let somebody go because you don't have work for them until you find one. So these are your variable costs. Now, the next category are your fixed costs. Unlike variable costs, fixed costs stay the same. These are the costs to run your business. And these do not usually go up or down when your revenue goes up and down. They will a little, but mostly they go up or down based on what's going on in the economy. The cost of living goes up, they'll go up 3, 5, 7% a year. But if you're paying rent on an office, you're going to grow pretty big before you decide I need a bigger office. You're going to be able to grow from 300 grand to 3 million before you go, we're busting out of the seams. So these fixed costs are the costs that you're going to pay, whether you have a $200,000 revenue or maybe a $1 million in revenue. They include your rent, your insurance, the owner's salary, maybe your bookkeeper's salary, all the costs of your platforms, unless your platform is part of the delivery for your clients. And typically, when you think about selling your company, a lot of times these costs all disappear. That's one of the reasons that companies buy other companies is they get all the people producing the product, but they don't have to duplicate any of the fixed costs. So these do not change based on revenue growth. And then the last bucket, so your variable costs, this is your gross profit. Your fixed costs, this is your operating profit. This is the money that you make from operating your business. And usually I want this to be EBITDA. I want this to be the earnings before taxes, interest, depreciation, and amortization, because this is truly the money that your company makes because of operating. Revenue less expenses is that EBITDA number. And then this last block, this is all about your capital costs, how you're using your capital, how you're minimizing taxes. It has nothing to do with operations. It has to do with how you're capitalizing and monetizing some of the non-operating costs of your business. So, and I call it OIBDA instead of EBITDA because I include owner's benefits here. So let's say you're making good money and you want to donate, $5,000 a month to cancer research. That's something that you've decided to do, and that's a benefit to you. You feel good about making donations. But if someone bought your business, that's not a fixed cost or a variable cost. That's a decision that you've made because you have the opportunity to do so because you're making good money. So that's an owner benefit. A lot of times we'll see cars down here or travel down here. These are the things that get buried in your accounting software, which I'm not suggesting you change. That's one of the nice things about running a business. But we want to separate it out. We want to take it out when we're going to look at the financial implications of decisions we make, because we don't want to impact those decisions by something that is not part of our operating system. Does that make sense? Are you with me? Okay. So here's what happens as you grow your business with these variable and fixed expenses. So we're going to start here with this $800,000 business. And the variable costs are 60%, $480,000. The fixed costs are 30%, $240,000, and profits are $80,000. Okay. Now, we are going to grow our business 20% the next year, and we're going to go from 800,000 to 970. It's a little more than 20%. Our COGS, look, we're going to keep the exact same ratio of variable costs. But if we have, let's say we have we have 4 consultants here in our $800,000 business, and we're going to grow to 970. We're probably, if we have 4 consultants, each consultant is doing $200,000 worth of work. So we're probably going to need another consultant here. Okay. But we're still in line with our margins. The nice thing about that is our fixed expenses, they're growing from 240 to 250, but the ratio is going down because they're not growing as fast because they're only growing based on cost of living increases. And so our margin has increased. So we've grown from 80,000 to 145,000, which is an 81% profit increase. Okay. These haven't changed, just the growth and keeping your variable costs in line will have that kind of impact. Now, let's say the third year, whoops, this is supposed to say year 3, bummers, not year 2. Let's say you grow 15%, and let's say you're able to reduce your COGS by a little bit. Let's say with 5 consultants, you're able to move them around a little bit. And so you don't need to hire a new consultant here. You can get those 5 to go all the way to $1.1 million. All right. You've got the ability now with 5 of them to move them around amongst the different projects. And when someone needs help, you go, okay, well, you don't need to finish that one. You can come over here. And so that's why when you're growing, you become more efficient because you have more resources at your disposal. So here, your COGS, your costs are going up, but your margin is improving. Your fixed costs, the margin's improving again. Numbers are higher, but the margin's improving. And now you're all the way up to a 20% profit margin and a 55% increase over last year. So this is why it's so important to watch these ratios. And you cannot see them in a standard financial statement because most of your QuickBooks, almost all of your accountants, I'm sure there's an exception, will put all your salaries into a bucket. That's the easiest way to do it. You're going through Gusto or ADP or QuickBooks, and you just stick all the salaries in there, right? That's the easiest way to do it. And we know all these people work for you. But by dividing them out, by saying these people are variable costs and here's the fixed cost, this is me and my bookkeeper, you're going to be able to see the relationship between these numbers, which becomes critical in making decisions. I hope that makes sense. I'm going to show you, oops, I'm going to go backwards instead of forwards. I'm going to show you this in action. So here are my financial statements from my golf course. All right, here's my QuickBooks. And here's what I call my BFF, my Bomba Financial Framework. So the first set of drivers, which is my revenue streams, my QuickBooks just gave me my total revenue. So I didn't really know what it looked like. So I divided it into my memberships and my greens fees. Those are my golfers. And then here's my restaurant and here's my pro shop. And here's the numbers. These are all my materials. This is all my equipment and my grass seed. And this is my restaurant cost of goods. This is the food. And this is the stuff that went in my pro shop. But that is not all the costs that were incurred in my variable costs because it doesn't have any people in it. When I add all my people, now I get a lot of information. Okay. I can see that my golf course here made $1.3 million. And it cost me almost $1 million. So I had a $300,000 profit in my golf course, running my golf course. I had a loss in running my restaurant. I sucked at running my restaurant. In the 7 years I owned it, I never made a profit. And so when I saw this, I made some changes so I could reduce some of the costs. And I reduced some of the services, but it didn't seem to make a difference. And my pro shop made a little bit of money, and that's really a service, just having golf balls and tee times available. So even though my gross margin changed dramatically, okay, instead of 65%, it was 26%. This is now something that I can duplicate and watch as I grow. Now my costs down here, my fixed expenses, marketing was the same. My salaries obviously here were very different because most of this 800,000 went up into these variable costs. And all my other expenses were the same so that I can see the 10% versus the 8.6. Now, why is that? Because I moved my interest and depreciation down below my operating line item. So almost always when you look at your BFF and when you look at putting your numbers in this kind of ratio, you're going to see that your operating profit is higher. And obviously that's the goal for running a business and selling a business and having more money on the bottom line. So that shows you, and then here's what happens when you grow. So here are my numbers across a trend, and you can really see the benefit of watching the variable and fixed costs. So we saw 18. I show you 18 because that's the first year I actually made some money. Remember, I was bringing this back from the dead, so it wasn't a pretty picture. But you can see my revenue grew 741, 1 million to 1,000,006. And my gross profit went up, my costs went up considerably, 7, 9, 1,000,002. But my margins, 103 costs to 78 to 73. So I was able to improve my costs, my variable costs margins. Not my costs were still going up, but the margin, I was making more money, 26% versus negative 21 to 26. And then my fixed costs stayed very similar, but the margins improved, negative 28 to 10. Okay. So that's what I recommend you do with your income statement. Really pull it apart and look at what are those revenue streams I want to watch? What are my variable costs that I want to aggregate? And yes, under my maintenance here, I had equipment, I had grass seed, I had lots of people who worked for me. I had a staff of about 15. But by putting them all together, I can start to see these numbers and these trends, and that's where you get good information. So here's the variable costs. These are all the costs that go up or down based on revenue. You want to keep that margin the same or better. You want to improve it. And then your expenses, oops, golly, I'm sorry. Then same thing, these expenses should not be growing considerably. They should be staying very, very stable, which means that you'll be improving your bottom line margin. Sounds simple, right? We're going to take a couple of pages of income statement and we're going to make it 15 lines. And then we're going to make better decisions because now I know who I can afford and how much I can afford. All right, that's a lot of information. Are there questions before I go on to a balance sheet discussion? We'll make that one real quick.
There weren't any in the chat, so if anybody has one, now's the time. Okay, guess we'll move on, Deb.
All right, we'll talk about the balance sheet. So when I think about the financial statements, so there are really three that we work with. The income statement we just talked about, the balance sheet, and the statement of cash flows. So the two that most people are familiar with is balance sheet and income statement. And I think of the income statement, if you think of an automobile, the income statement is the engine. That's what's running the business, right? You get money in, you spend money, it goes out, and then you get something that's left. The balance sheet is like the chassis of the car. Okay, that's where stuff sits. It's where your assets sit, it's where your liabilities are and your equity. So this isn't you need the engine to move you along to create a change in your balance sheet. And your cash flow, cash is king. Cash is whether it's an electric car or a gas car, cash is what keeps the engine running. Okay. So in talking about the balance sheet, the balance sheet is really where you can build your wealth. This is where this is where your assets sit And you can see, hey, I'm increasing assets and I'm reducing loans. I'm increasing my equity. I'm increasing the ownership in my business. And I'll walk you through this real quickly so I'm hoping everybody's familiar with the balance sheet. Assets on one side, what you own, what your company owns, and liabilities on the other side, what the company owes. Now, the first thing that people don't realize is they're always surprised that your equity is on the liability side. It's like, why? So the liabilities that are payables and loans, this is what your company owes third parties. You know, your credit card guy, your vendors. But the equity, this is what the company owes you, the owner. And so you want to create some equity. You want to create some ownership, positive ownership, because that's where you're building your wealth. And we'll talk about that in a minute. Okay, so here are some things that you absolutely must remember about your balance sheet that people do not remember. What you own and what you owe, and the equity is what the company owes you. It has to balance. I can't even tell you, when I was banking $100 million companies, every so often a balance sheet would show up and it wasn't balanced. Well, something is terribly wrong if it's not balanced. And that just shows that you're not taking good care of your books and you're missing something. And so it's very hard to believe anyone's books, their income statement, if their balance sheet doesn't balance. Something's not right. Now, the balance sheet is a point in time. So a balance sheet has to have a date on it. Your income statement, as you saw from the previous discussion, is over time. So I'll tell you, here's 12 months, here's last year, here's this year. But a balance sheet is always at a point in time. And it can change pretty dramatically. If you got a loan, you could go from, all of a sudden you have $100,000 in cash and $100,000 loan. That's a big change on a balance sheet. Numbers are cumulative on your balance sheet. So the first day you open your business, you have got to get your chart of accounts correct, because your balance sheet is cumulative. Every day, every time you have a transaction, your balance sheet will change, and you don't get to go back and redo it. As opposed to your income statement, every year you get to start over. Now, there are a couple of different parts of your balance sheet that we watch. Anyone who's working with you on finance. The first one is your working capital. Working capital, this is the money you're using to run your business. This is working capital. Current usually means within the next year. You're going to collect accounts receivable within the year. You're going to pay your credit cards within a year. But I recommend that you think about current as within 90 days. This is within a quarter. All these things are I do this because that's turning. You're going to get all of your accounts receivable paid. They're going to pay you. You're going to pay all of your accounts payable within a 60 or 90-day period. And a lot of banks, when you go, will look at this current ratio. We always want your assets to be more than your liabilities, which means you have the funds to pay make payroll. You have the funds to pay your vendors. You have the funds to pay your credit cards. So your current ratio should always be more than 1. So anytime you're looking at your balance sheet and your assets are less, your current assets are less than your current ratio, your current liabilities, you really got to think about what's going on and how can I improve my current asset position. So here are some of the things that I find in balance sheets that are not correct. Okay, numbers are at cost. So when you buy an asset, when you put it on your balance sheet, it's at cost. And it never goes up. It only goes down. You can only depreciate it. So if you looked at a balance sheet for my golf course and you knew I owned all this equipment, but I had 0 assets, you'd know that I had depreciated it all. So you know it's probably old equipment, but it still has a value, but it does not show up on your balance sheet. A lot of times shareholders' loans will be shown as liabilities. That's what the accounting rules are. If you put money into your company, it shows up as a long-term loan. But if you're giving it to your bank, you can move it down into an equity section. The bank owes it to you. It's not a third-party loan, and that will improve the equity position, and it'll help you get bank loans. It'll help you get business because you have a strong capital position. Retained earnings plus net income minus distributions, this should all reconcile. This is your equity section. Lots of times these do not reconcile and the balance sheet doesn't balance because the equity, you've taken some money out and you've forgotten to record it. That's a big no-no. And then a lot of people think the equity is what the value of their company is, and that's not the case. But equity is really important because that's what you leverage to borrow. Banks like to see equity because you can borrow 2 times what that equity is. So when I tell you that the balance sheet is really important because the assets that you own, you can leverage to borrow other people's money instead of using your own. That's what creates the ability to have resources to grow your business faster because you're using other people's money. So I'm going to run through this real quickly. So here's my golf course balance sheet. It balances. So we passed the first test. I look at the current assets are more than the current liabilities. And then I look at, these are the long-term assets. The long-term assets of the golf course are greater than my debt. So that's also good, which means I have some equity. Now, when I look at my equity part, I put in $500,000 and my retained earnings is negative. That means I have not been earning money. My net income for the first year is positive. So I'm starting to build back my total equity, but I've actually lost money. So what you can tell, because it's cumulative, your retained earnings are going to tell you what's going on with your business in the past without even having previous financial statements. So this gives a lot of information about how you're managing the business. Now, it also is a part of what I recommend is when you're making money, I recommend that you leave some of it in the business and you take some of it out. So if you're an LLC or a S Corp or an LP, you're going to have to take some money out to pay taxes. But I recommend that you take some money out and put it in another investment and leave a third of it in. So a third, a third, a third. And that way, the third that you leave in, you can leverage. The third that you take out, you can put into another investment. And that way you can build your wealth at the same time you're building your business. Now, I don't suggest you do this in a very beginning because you're not building enough equity yet to have the ability to borrow. But longer term, what happens is people leave all their money in their company and then they are not able to sell it for as much as they thought they should. Or they take it all out and they can't leverage, so they can't grow fast enough to get ahead. So this is one of the tricks that we, in my Business Owners MBA, we spend a lot of time working on, what's the right balance. So I don't know if we have any questions. We have 10 minutes.
You actually have till 7:30, Deb.
Oh, gosh, I've been talking so fast. I didn't realize I had an extra time. Okay, so here, I'll make you do this with me. So because I'm tired of talking. So if I borrowed $100,000 on my line of credit, how would that show up on my balance sheet?
As a loan. I'm looking at my balance sheet while you
That's
were
perfect.
presenting.
As a loan, that's exactly right. And it has to balance. So what balances the loan?
The liabilities?
That's, yep, the loan's a liability. So if you got a $100,000 loan from a bank, what is that? What kind of asset would that be?
Not equity.
Nope, nope. That's the liability side.
Yeah. I'm all out of answers.
No, you're not. Think, if if I gave you $100,000 check, what are you going to do with it?
I'm gonna spin, so that's expenses.
Okay, no, you're going to put it in the bank.
Cash.
Okay, yes,
Cash. It's cash.
yes, gotcha.
So
Gotcha.
you get
Okay.
you get $100,000 on the loan. You get $100,000 in cash. Now, the second question, what if you spent $50,000 on a piece of equipment? So now you have $100,000 in liabilities. Is your equipment an asset?
Yes. Yes,
Okay.
it is.
So you'd
Uh-huh.
have $50,000 in equipment, and the rest of it would still be
Still be in the bank.
yeah,
Right.
still be cash.
Right.
Okay. So it still balances. So that's one of the things about balance sheets that is sort of magical, because anytime something happens on one side of the equation, it's got to happen on the other. So here's another one to think about. What if I sold $250,000 of common stock to an investor? Okay, so where is common stock on the balance sheet?
And the liabilities.
Uh-huh, in the equity portion. And
Right.
so they get common stock, and what do I get?
Capital stock. Net.
Somebody help Pamela here.
Please help me.
Is it cash?
Yes, of course it is. That's why you sell stock. You need the money to grow. Now, one of the things that's unfortunate about the balance sheet is that it doesn't tell you who owns the company. So if we sold $250,000 worth of stock, we could maybe own half the company, we could own a quarter of the company, or we could have only sold 10%. We don't know that from the balance sheet. But what we do know is we got additional cash in the form of equity. And equity is different from a loan, because a loan you have to pay back and you have terms and all of this, right? But equity, they get a piece of the company. And so usually when you sell a piece of the company, you have some kind of agreement on what kind of return, or they want a return, and it's going to be X or Y. And so you have to now keep your investor group happy, whoever they are. And so selling common stock, a lot of people think, oh, I'll just raise some equity money. But equity money is very expensive, because you're giving away a piece of your company, and they're expecting your investors are expecting a 20 or 25% return, because investing in a private company is very risky. If you could get a bank loan and even pay a 10% interest rate, that's a lot less risky, because one, it's less expensive, and two, you haven't given away any of your company. So, but some businesses, like the big IT businesses, are like Uber. I mean, Uber had to go out and find drivers and get cars and do it nationally. And so that costs a lot of money. So they raise a lot of equity, and then they burn through it as they develop this massive infrastructure. But us small business owners, we don't have to do that. And we usually get some money from friends and family and fools. Our 3 F's can help us out. And a lot of times then we don't even have any kind of payment agreement. We just ask for some help, and that gives us a little capital to get started in that equity section. Okay, so this one's tough. This one's trickier. What happens if I sell a lot of golf shirts? Okay, So my golf shirts are probably sitting in the assets on my balance sheet. So here are my golf shirts. Oops, I don't even have inventory on here. Let's call them here. They're in this other current asset. So if I sell these, this number is going to go down.
Mhm.
What happens? What number is going to go up?
Cash.
Absolutely. Absolutely. I get cash. And if I sell them for a profit, eventually I'll have it come down here and I'll make some net income. So that's where now, all that accounting starts being really important, because now we have to know, what did I buy the shirts for? What did I sell them for? And then what was the cost to hold them, to carry them? How much did I pay while they sat on the shelves? I had to pay people to make sure that they were, folded and pretty to sell. And so all of those costs are on my expenses. And the only thing that really hits my balance sheet is net income, the asset and net income. So this is where we hold things. Okay, excellent. Let's see. Last question. I have one more, I think. Whoops, I'm going the wrong way. Okay, so what would happen if I stopped paying my vendors?
Increase
so
in liability.
my vendors are up here, right? Accounts payable. So what was the answer?
Increase in liability. Here. Okay.
Yeah, they would certainly go up. So I stopped paying them, so those liabilities go up. And what else how would I balance that?
Your
Okay.
credit card debt would go down because you're not paying them. I don't know.
Yeah, that's a possibility. This one goes up, and no, it wouldn't go up. It would go down. So yeah, they could balance out. Usually what happens when people stop paying you as a vendor, it's because they're short of cash. So they're building cash. So when you're collecting receivables, right? What's a receivable? Receivable is when you've delivered a product or service to your client and you're waiting for them to pay you. That is a very large asset. Okay, that's an asset that you've done all that you can do. You've delivered your product and now they owe you money. You are now their bank and you want to collect that as quickly as possible. But when you're in trouble and when you're in cash flow problems, then you stop being able to make those payments and you're hoarding the cash. So what happens is you stop making these payments. And that's the first red flag. If you have a client who's paid you every month on the 30th of the month, the 30 days from your invoice, and they start paying you in 45 or in 60 days, that should be a red flag that you need to get on the phone and call them and find out what's going on and see if you can get a partial payment, because that's the first red flag that something's not right. And conversely, I always tell my clients, if you're getting a invoice and you're dropping everything you're doing to pay that invoice the same day, that's not good money management either. You should pay your invoices like twice a month. Invoices that are due on the 15th or invoices that are due on the 30th or the 1st. Just say, I'm going to do invoices twice a month and collect them, and then just do them all at once, rather than starting and stopping whatever you're doing during your day and try to pay an invoice. Because you want to make sure that you have sufficient cash flow to make all of those payments as well. Okay, well, I raced through there because I just wasn't paying attention to the time. So what we covered today, and I'm happy to talk about any of these because we have a little time. What we covered today is really income statement and balance sheet, because those are two that we focus on the most in our early stage businesses. And that's the one that most business owners are the most familiar with. The statement of cash flow tells exactly what I was just talking about. The cash flow, the collecting of the receivables, the paying the vendors, what those time sequences are, and how do you make sure that you always have cash available to make payroll. I hear so many clients go, I don't have money to pay payroll. I have a great income statement. I'm making a ton of money, but I don't have any money. How come? And it's like, well, you haven't collected your receivables and you've been paying all your payables way too quickly. So you have gaps in your cash flow because you're not collecting, but you're paying. So that's not an even balance. Now, you have to pay your employees. You have to pay the people who work for you. You always pay them on time. And so that creates the disconnect if your clients are not paying you in a fair manner, in a timely manner. That's where you run out of cash flow. And as a starting business, as a company that's having cash flow problems, I recommend that you put together a cash flow model that's weekly. And so hey, I'm going to get my receivables. I can collect this one this week. I'm going to collect this one next week. I'm going to collect this one the week after, and I'll have sufficient cash to make my payments to my employees. Now, how do you know you're going to collect it this week and next week? Because you set up a system and you watch. Well, when I billed client A, they paid me in 30 days. And they've done that every single month. So I know I billed client A on January 1st. So I know they're going to pay me by February 1st. So you start being able to see your clients' payment patterns. Just like I recommended y'all set up payment patterns twice a month. Your vendors will know, hey, she always pays me on time and she pays me in this sequence. So you start to see, okay, when I send this bill, I know I'm going to get paid here. And so now you can start tracking, and then you can start matching the expenses going out to when you receive money. We talked a little bit about working capital and leverage ratios. That gets a lot more complex, but the working capital part is partly that cash flow, when money's coming in, when it's going out, and how you make sure that it's balanced. And leverage is how you can accomplish getting additional resources from banks or from CDFIs. And obviously y'all figured that out by getting grants, which means you don't have to have these kinds of leverage ratios already set up. Budgeting and projection models. This is where, when I had my 3 years of golf course financials lined up, you start looking at, okay, this is how I've grown each year. What am I going to do next year? And setting a budget is really an important skill set, not because you're going to get it right. You are never going to get it right. The world changes like we never imagined, and you're never going to get it right. The most important thing about thinking about budgeting, which is the next year, or projection models, which is the next couple of years, is the thought process. What am I going to do? Am I going to raise prices? Am I going to look at having additional service so I can increase my revenue? Or am I going to continue to spend money in marketing and bringing in new clients? So thinking about those, am I going to need new people? If I grow 20%, like I think I'm going to need to bring on a new person. How long is that going to take? How much is it going to cost for me to bring her on board before she's covering her salary? That's a cash flow gap. It's a working capital need, because she's not going to come in and start, creating twice her salary in revenue. It's going to take time for her to learn your systems. So those are the reasons that you think about budgeting and setting up projection models. KPIs, key performance indicators. So your financials look backwards. Here's all the information of what you've done in the past. What I like to do with KPIs is look for leading indicators. So last year I brought in 4 new clients. Well, that's 1 a quarter. How much did it cost? How many leads did you have? How many sales calls did you have to get that one client? And so that way we can see, well, if it took took 5 different sales calls, we know that next quarter we have to have at least 5 sales calls. And if 5 sales calls took, 10 leads, well, then we need to have that 50 leads to get 5 sales calls to get 1 client. And so now you can start planning, am I ahead or behind? Sales is easy. When we start talking about KPIs in terms of quality, in terms of timeliness, delivering your product, there are so many different pieces of running a business. You really want to set those so you know what's going on ahead of time, so that you know that your results are going to be profitable and that profit margin is going to increase. And then lastly, we talk about valuation. Based on your EBITDA, what are those multiples and what are exit strategies? A lot of my clients end up selling their companies to their employee base. A lot of them pass them on to their family. You have to, the IRS wants their cut when you've got your son and your daughter working in your business. You can't just give it to them. The IRS doesn't like that. They come and get you. So you have to figure out, how am I going to value this company so I can pass it along to my kids with the least burden to them? So there are all kinds of pieces of that we talk about. Okay, I am done talking. And I am happy to just answer any questions or let everyone go home early. Did I get in trouble if I say that?
No,
Or
we don't mind giving time back. That's always fantastic.
if you have, I'm happy. I think you have, I don't know if I've given you or Tracy or Donalisa have given you my contact information, but I'm happy to answer any questions.
We have not given your contact information. I don't know if you want to throw that in the chat, Deb.
I'm trying to get rid of my.
Oh, I can help you with the stop share.
Yeah, go away. I kept my share is, oh, thank you. I couldn't find my share. It was covered with pictures of people. Okay, so I can put my contact information in here. Okay, I just want to know, was that way too much information? Not enough information? Interesting, not interesting? Any feedback? What did you learn? Well, I tried to type.
This is Pamela. I learned a lot. Accounting is kind of my arch nemesis. So I have someone for that. But it is helpful to kind of see the breakdown, and it's interesting to see the Bomba model. And I can see how that then gives you the absolute snapshot, so you kind of know what you're working with. All the other numbers are all great, but it can get intimidating. So thank you for the presentation. Still my nemesis, but I do believe.
Well, and it sounds like you're doing the right things in terms of having an accountant or bookkeeper that's doing it for you. You do not have to understand accounting per se, but you do have to understand the accounting for your business. Like, these are the weird things. Like, if you're in construction, you might have percentage complete. If you're in oil and gas, you have depletion accounting. But if it's straight up simple, just ask those questions of your accountant and make sure that it looks, each year, month over month, year over year, those numbers are compatible. They look okay. You don't have to be an accountant. You just have to have a good bookkeeper keeping track of those books for you.
Yes.
Um,
And
and
it's
then
that time of year of pulling together all of your expenses and all that great stuff and keeping track so that I can provide that information. I'm not very excited right now, so.
I understand. And I can't even tell you the number of business owners I work with where the first thing that happens is, I say, let's see your numbers. Let's talk about where you want to go, where you've been. And we pull up and their balance sheet doesn't balance. Their numbers don't make any sense. It's like, well, are you paying yourself? Oh yeah, I'm paying myself. Well, where's that? Are you paying your employees? Well, they're 1099s. I'm like, but they still need to come out of your income statement. Where's that? And so then we have to go find somebody who can actually get those numbers correctly allocated on your financials. And so finding a good bookkeeper and obviously eventually a CPA to do the taxes is a critical part. But if you can find a good one, you don't have to be part of that accounting. You just have to start manipulating the numbers so you can use them and make decisions. Make sense?
Sorry, I couldn't get to mute. Yes, absolutely. Thank you. Yes.
Oops.
And thanks for sharing your information as well.
I didn't do a good job on my okay. That didn't work at all because my name is part of my chat didn't look right.
Well, Donna Lisa, you can send it out tomorrow, right, with the video,
Yes.
so
That's good.
everyone will have it.
Actually, I can throw it in right now because I just found it.
There. Yeah, I got that part. I think on the first one I sent, it said I attached my name to everything, no spaces.
I
Well,
liked
that
how
would-
you broke out your revenue drivers at the very top, Deb, especially like if you have a new product or a new service that you're rolling out, and that's a great way for you to see, is it making any money? Is it worth the effort, or is it something that maybe isn't working, so we need to either pivot or get rid of it? So I liked that.
Yeah, I have a woman who runs an insurance agency, and she had, she had healthcare, she had P&C, property and casualty, and she had this really high-end insurance product that she loved. She loved selling it. She made a lot of money, she thought, but she had all these costs associated with it. And when we broke it down and then put the variable costs, I was like, you're making no money. You're spending a ton of time and you're making no money. And she's like, whoa. And so she was able to find a way to provide the service, but also get paid for it. So that it's a surprise, but I've been teaching my Bomba classes for 30 years now. In 2025 is my 30th year. And when I show people that whale chart, everyone's like, that's not me. But for 30 years, I'd say about 90% of my clients, when we actually get all those numbers separated out and properly allocated, it's like 90% of them will fall into that 20% not making money. And most of them are 25 to 30% are making good money. But that's still 50% of your clients. You're just working for the fun of it because you're break even. And I had a credit guy when I was at the bank that used to tell me, I used to go, hey, I've got a new credit deal I want you to look at. And he'd say, I don't need the practice. Is it going to be a good loan? Well, so I tell my clients, you don't need practice. You're good at what you do. You don't need these 10 clients in the middle who aren't making any money. I mean, they're paying you, you're paying all these expenses, and you have zero to show for it. We don't need that. That's it's tough enough. We need to make it. And the thing that's great about the break-even ones is every dollar you get goes right to the bottom line. So if you can figure out a way to give them, $100 more in value, that's just straight to the bottom line because you've already covered all your expenses. So that's just free money. I have a client who he services contractors. So like, if you're building a house, he provides certain services that you need during that building process. And the clients will call him, his home builders will call him and go, okay, I need you here in 2 days, or I need you here in 4 days. It's pretty much, Johnny on the spot, but he usually has 24 hours, 48 hours to get his crews out to the site. And some days his clients will call him, I need you here right now. And he's like, so he shuffles his crews and he gets someone out there for his top 20 clients. And I'm like, why aren't you charging them for that? And so he's doing something that creates value for his clients, but he's not charging them any extra because, I'm a service company and I'm like, no, if they tell you to drop everything and show up. And he looked at me and he goes, they always tell me it doesn't matter what it costs. I need you here. I said, you need to take advantage of that. If they're telling you they're going to pay you whatever it costs, charge them. And he's like, that would be all bottom line. I go, if you do that enough, you're going to be able to pay your team a bonus, and it's free money. Just think you can increase their bonus and you don't change anything that you're doing. That's one of those middle growth plans. Sometimes we make improvements to our business that creates value and we don't even think to charge our clients for it. Hey, I told you it's going to take 2 weeks to get this done, but I got it done in a week. Okay, so next time you have that same opportunity, say, hey, it'll take 2 weeks and cost X, but if you want it in a week, it'll be X plus $200.
That's great. Thank you so much, Deb. I know this is a subject that's difficult for a lot of people and hard, but even just knowing this helps you as a business owner because those numbers are important and you at least have to know what they mean on there and you can make sure they're doing everything right for you, even if it's someone in your firm or whatever. So thank you.
I
All right.
did have one question. Sorry. So I felt like I got a lot of clarity on what I don't know in terms of building a business, which was really good. I find that that's helpful. But as I'm starting to work on the part of the program where I'm trying to build my business plan, and this is where I'm getting stumped because I'm a new business and like all the financial bit, like I can do all the narrative and all that other stuff, but it's the financial bits. And I was wondering, as we go through this program, is that when we speak with the folks at TWU to help us like push through this?
You can work with advisors on that because if you've never done it, they can help you. They can help guide you. And in Life Plan, it's pretty easy to break things down, but they can take you through it step by step so you know what you're putting in there. So like
Okay.
if there's a bakery, one line would be cakes, one would be whatever, and you'd put a value to it. Those numbers are all based on something.
Okay.
So
Okay,
yes,
thank you.
that's why we want you to have advisors too, because those are things you can use it however to help you in your business.
Okay, thank you.
You're welcome.
Deep breath, Stephanie. One of the advisors will definitely help you navigate that for sure. We will not leave you hanging.
Well, and Live Plan does walk you through some of those. It gives you questions that help you think about that. It's structured so that you have some advice. I mean, it's an advisor and says, what about this? What about this? And so it does help you think about them in smaller steps.
Definitely here to support.
Deb, this
Oh.
is Pamela Baker. Sorry, final question.
Yeah, no.
Is there a recommended time to kind of look at like where your company is and consider either a line of credit or a VC, a venture capitalist or angel investor? What's kind of that mark, if you will? Is it 2 years or 3 years of having a positive equity and a growth of equity, even if the margin is small? What makes you the best candidate and how do you determine? Probably a loaded question.
So line of credits. I mean, you can start talking with banks or with like Lift Fund, a CDFI for line of credit. Their average loan is $35,000. And it's great when you can, you have enough profit to be able to cover the costs. So if you have a line of credit, let's say a $50,000 line of credit, and think about the resources that what you could do with $50,000. The cost of that is $5,000 a year, 10%. Okay, that's a pretty small cost to be able to use $50,000. Buy a marketing plan, buy a resource you can use to sell, buy a person that, can come in and work with you and create additional value. And so now that would be a line of credit. So that's the additional cost. Once you've created the value, you have to pay that principal back. So you have to know that you're going to create enough value to pay down the loan. So I always say baby steps, but loans are easier to get. Now, when you start talking about angel investors or VCs, it doesn't matter how long your company has been around. I mean, you probably need to be around for at least 2 years, but the driver is going to be your EBITDA. And most angel investors don't look at a company until they have $1 million in EBITDA. Now, that could be $10 million in revenue, or it could be $2 million in revenue, depending on how your margins are and what is what your industry is and what those numbers look like. But most of them won't play until there's $1 million in EBITDA. And the reason for that is that creates the impression that you're a stable business that has repeatable, sustainable revenue streams that are reliable. So every year you're going to have these revenue streams, and that's sort of a bottom line number to talk with the equity people. Now, if you're in IT, what you need is a product that you can say, once you have my bot or my AI, everybody in the field is going to need to have it, and therefore I need $10 million to produce it, and then we're all going to make $100 million. So that's why the IT field grows so fast, because once you've created a product, it's very easy to disseminate. Now, it may not be easy to compete against, Google and Amazon and Microsoft and everybody else who's already built an AI. But if you have something that's very specific and nichey, that's a very different story, because then you're looking at what the opportunity of taking that to market is. So it's very different for different industries. That's
Got
a
it.
pretty wishy-washy answer, but
No, that helps. That does help. I'm trucking, but IT. And so to your point, I have a niche product that I'm looking at, okay, what's my pitch? I'm
well,
looking at, go ahead.
so if you have something like that very specifically, my recommendation is you find 1 or 2 companies that are willing to pilot it, so you have proof of concept. So you may not necessarily have all the bells and whistles on it, but you have proof of concept, because then you're going to get a much more reasonable offer from a VC. If you say, I have this niche product that's going to work for all of these truckers in just this market, and it's exactly this, and that's what's going to happen, and you have improved it, you'll end up with, $3 million, $5 million to build the product, but you'll own 2% of the company. If you have proven that product works with 2 companies and you say, look, we've rolled it out and we need $5 million, and here's the proof, these 2 companies saved, 20% of whatever that cost is, then you're going to be working with something that, they're going to go, well, here's your $5 million, and we'd like 20% of your company or 30% of your company, because now you've proven that it works.
Got it. That helps a lot, especially the proof of concept and the pilot with the companies.
Yeah.
And that's something else that I'm pursuing. So makes
Perfect.
sense. Thank
Yeah,
you.
perfect.
Awesome.
Okay, were those all the questions for Deb? All right, Deb, thank you so much.
Thank you. Good luck, everybody. And I'm happy to be a resource if you need additional support other than, I mean, you have a lot of support with this program. So good luck with it all. I'm
Thank you,
excited to
Deb.
follow you all.
Right, thanks. Did any of you have any grant